Well, greetings. For the next few minutes, we'll be spending a little bit of time with Matthews International, ticker symbol MATW, taking a closer look at their business and the current investment opportunity in the company. My name is Mark Robertson. I am founder and managing partner of Manifest Investing. You can see contact information there at the bottom of the slide. If you're a Twitter person, you can follow me at Manifest Invest. The email address can be used for questions and answers as a follow-up or to request copies of the presentation. And like I say, we'll be taking a closer look at Matthews, the funeral services and branding company shown here. And everything that we do here, no investment recommendation is intended. This is for educational purposes to illustrate the methods and techniques that we use at Manifest Investing as inspired by the Modern Investment Club movement. Every week at Manifest Investing, we take a look at the companies in the update cycle from the Value Line Investment Survey. We know that a lot of long-term investors use Value Line. In this case, Matthews International popped up with a couple of key characteristics. We noted that the low total return forecast, as shown down below there, is a fairly interesting indicator. And in this case, that 17% return is attractive. We know that the average low total return forecast right now is about 8 or 9%. So again, Matthews is at quite a premium to that. And then as you look over to the right, the company has been stuck in something of a trading range for literally 2 or 3 years. And we noticed that, again, as shown here, the difference between the current stock price and the theoretical price as established by Value Line's price to cash flow analysis is gapped probably wider than it's been in quite some time. At Manifest Investing, we focus on 2 core characteristics for all investments. We use a business model analysis to establish a projected annual return forecast. So our return forecast is always based on an analysis of the company's top and bottom lines over a period of time using both historical data, analyst estimates in this period here, always a 5-year time horizon. But we're basically trying to build the long-term trends both on bottom line and top line for the company to produce this long-term return forecast, again, projected annual return or PAR. Based on the works of Benjamin Graham and George Nicholson, one of the founders of the Modern Investment Club movement, we do pay a lot of attention to company quality. You see the 4 factors that form our composite or our index of quality for any company, and they're basically scored from 0 to 100. Matthews ends up in the top quintile of all companies that we follow, about 2,500 companies. So we would deem Matthews to be an excellent company in that regard. Here's a look at the business model analysis. You can think of it as an income statement type analysis from the top line to the bottom line. You see 7 or 8 years of operating history from left to right from 2004 to 2011. A couple years of analyst estimates included for years ending 2012 and 2013. Based on the picture that you see here, the long-term trend is estimated at something on the order of 6%. That's basically what you see forming here. And again, you can also have the price bars for the company. The black are the price bars, the earnings at the bottom line. So you literally have a pictorial illustration of P versus E, or the PE ratio, where historically the difference between price and earnings has been gapped a little bit more. As you look at the current conditions, as shown right here, the price is basically closer to the long-term earnings per share trend line than it has been in some time, suggesting a potential buying opportunity. Basically checking in on the profitability characteristics of the company, there has been a little bit of a decline over the last couple of years, appears to have stabilized, and according to the analyst consensus estimates for the next couple of years, does definitely seem to be stabilizing somewhere in the 8% range. Here's a look at some of the key characteristics. We've superimposed the annual PE ratio so that we can see that the company has been in the upper teens for quite some time, going back a period of years, has spent a couple years at lower levels. Value Line expects it to return over the 3 to 5 year forecast to more like the 18 range for the multiple. The profit margin, again, has been compressing as shown in that previous graph. This just gives you the figures. And basically we'd see that anything in that 8 to 9% range would seem to make a lot of sense. Here's the current income statement for the company on the left-hand side. All the numbers on the right-hand side are the 5-year conditions based on certain key assumptions. We have 3. The first milestone is the sales growth at 6%. In other words, this $900 million company, if it grows at 6% going forward, will become a $1.2 billion company 5 years out in April 2017. Going to use 8% for a projected net margin. At that rate, we could build an earnings forecast of 377. We'll use 16. Again, that's kind of a blend of Morningstar, Value Line, S&P, a few other different things that we look at, but again, comparing it versus the numbers that we see up here at the top of the slide, not too far out of the ordinary. Throw in a percenter for approximately 1% for our projected dividend yield, and we come up with our result of our return forecast at about 15% projected annual return, or par. Here's a quick look at the technical analysis of the company. We like the fact that it's down more closer to oversold at 42 down in here. A little bit of an interesting pattern here. Again, it has been stuck in the mud for quite some time, and if anything, we see the potential for support somewhere in the 28 to 30 range, so we also like that. So in summary, here's a look at some of the major sources on the company. You can see that S&P checks in with a fairly strong quality rating on the company, with the growth expectations somewhere in the mid-single digits, which would align pretty closely with our consensus forecast, and profit margins in the 8 to 9% range, PEs in the low teens, and S&P currently has a buy. Value Line again checked in with that low total forecast of 17, a little bit more modest expectations when it comes to growth. Again, the profitability checks pretty well, a little more optimistic on the PE side. The growth forecast per share probably is a little bit biased by the Great Recession, and basically it's kind of by the nature of their calculation, it's kind of a trough to peak situation, so I would discount this a little bit in here. So in summary, we basically see a company with a return of 15%, coming with an excellent quality rating. That's thanks to a financial strength, which is pretty sound. That's basically an A+ rating. Their effective interest rate on their long-term debt is about 5.5%, again, fairly typical. And we'd go with a growth forecast, again, somewhere in that mid-single digits range. Profitability of 8, valuation of 16, and it would net out to be a buy characteristic with it's basically in the top third percentile, in the 97th percentile of all the companies that we follow. There's a few companies that are a little bit more attractive, but it's pretty good. Again, the relative strength index is closer to oversold, and a little bit bearish, something a little bit to be concerned of, with a point and figure price objective of 22. So again, just something to keep in mind. That flat spot may continue for a while. Over at the Motley Fool's Caps stock picking experiment, it's not very widely followed, but those all-star stock pickers who do follow it, 100% of them think it will outperform the S&P 500, at least over the near term to the next few years. So in summary, we see a company that's definitely worthy of taking a closer look. Again, the contact information for me is on the page, and good luck, and we'd love to hear what you think of it also. Take care.